Cathie Woods makes a bold prediction about Tesla's stock price. Here's everything you need to know in today's video. Welcome to Trade Daily, where we break down all the best stock market news. Like and subscribe to keep up to date with the stock market. And I really hope you enjoy this video. ARK Invest CEO Cathie Woods has earned a reputation for bold predictions. Her asset management firm became a Wall Street sensation during the early days of the pandemic as the ARK Innovation ETF delivered triple-digit returns in 2020. Unfortunately, those gains have since evaporated, but Woods hasn't budged from her medium-term price targets on Tesla and Roku, both of which rank among the top 3 holdings in the ARK Innovation ETF. Specifically, ARK estimates Tesla will trade at a split-adjusted $1,533 per share by 2026, which implies a 688% upside from its current share price. And it estimates Roku will trade at $605 per share by 2026, which implies a 924% upside from its current share price. Are those forecasts realistic? Tesla has been a disruptive force in the auto industry from day one. In addition to popularizing electric vehicles, the company uses a novel direct-to-consumer sales strategy to drive efficiency by eliminating dealerships from the equation. It has also cultivated a premium brand image and inspired incredible demand without traditional advertising. In fact, Tesla topped the industry in battery electric car sales in the first half of the year, capturing a 19% market share. The company has also become a case study in operating efficiency. Thanks to innovative battery cell technology, Tesla pays less for battery packs than any other automaker according to Cairn Energy Research Advisors, and its leadership is expected to last through the decade's end. Additionally, its single-piece casting technique, meaning the front and rear body of the Model Y is cast as a single piece of metal, has greatly reduced the welding robot count at the new Gigafactories in Texas and Berlin. That relentless pursuit of manufacturing efficiency continued to pay off in the third quarter as Tesla once again achieved the highest operating margin in the auto industry. Despite missing delivery estimates, the company still grew revenue by 56% to $21.5 billion, and it generated a record free cash flow of $3.3 billion. Looking ahead, management says full self-driving technology will eventually be the greatest source of profitability. That is the cornerstone of ARK's investment thesis. Woods expects robotaxi revenue to approach $290 billion by 2026, while lower-margin EV sales will contribute about $480 billion to total revenue. That prediction is very ambitious at best and wildly unrealistic at worst. Tesla won't have a robotaxi in production until 2024, and scaling an autonomous ride-hailing service to $290 billion by 2026 sounds a bit far-fetched. That said, Tesla does have more miles worth of autonomous driving data than its rivals, and data is the cornerstone of the artificial intelligence that will one day drive these vehicles. Tesla has also demonstrated its capacity for innovation on countless occasions, so it's reasonable to assume robotaxis will be a key part of its business at some future point. While 688% returns by 2026 are probably unrealistic, this growth stock is still worth buying for patient investors. Roku is the most popular streaming platform in the world, both in terms of devices and viewing time. In fact, Roku holds nearly twice as much market share in both categories as the next closest competitor. That makes Roku a valuable advertising partner, and it monetizes brand relationships with OneView, an ad tech platform that allows marketers to run targeted cross-channel campaigns on connected televisions, CTV, desktops, and mobile devices. Unfortunately, many brands have cut their ad budgets due to softening demand as people continue to battle high inflation, and that trend hit Roku hard in the third quarter. Revenue rose just 12% year-over-year to $761 million, and the company posted a GAAP loss of $0.88 per share, down from a profit of $0.48 per share the same period last year. But investors shouldn't read too much into those results. Roku's still growing faster than several other ad tech companies. In fact, Alphabet reported 3% growth in ad revenue in the third quarter, while Meta Platforms actually saw sales decline 4%. Moreover, Roku is the most popular streaming platform by a wide margin, and that positions it for strong growth as the economic climate stabilizes. Omdia estimates online video advertising will surpass traditional television advertising this year, growing into a $259 billion market by 2026. That's the cornerstone of ARK's investment thesis. Woods assumes Roku will see approximately $10 billion in online video advertising revenue in 2026, meaning it would have about 4% market share. That estimate isn't unreasonable, but ARK also expects Roku to reach 157 million active accounts by 2026, up from 65.4 million in the most recent quarter. That implies annualized growth of 23% for the end of 2026, a meaningful acceleration from the 16% growth reported last quarter. Roku will benefit as more ad dollars shift to online video, but economic uncertainty will probably slow active account growth in the near term as high inflation continues to suppress demand for streaming players and smart TV. It seems unlikely shareholders will see 924% gains by 2026, but this growth stock is worth buying and holding. EV stocks have plummeted lately, but giving up on this market is a mistake. Electric vehicle stocks have taken it on the chin lately, and many investors who were previously bullish on the EV industry are now left wondering whether there's still a good way to benefit from the massive shift to electrified vehicles. I think there is, but not all EV stocks are going to benefit, and it's going to take some patience to see the eventual payoff. Here are a few things that are going wrong and a handful of things going right with the EV industry today, and why there are at least 2 stocks worth owning. The bear case for the EV industry if you're an EV bear. Coming up with a list of reasons to stay away from these stocks right now is pretty easy. Supply chain shortages continue to rattle EV production. There's a semiconductor shortage. Yes, still. Inflation is running rampant, driving up the costs of materials and vehicles. COVID-related lockdowns in China have hampered some EV companies' production. Need I go on? EV companies saw their share prices go on a near-euphoric rise in most of 2020 and 2021 as stock market investors practically threw money at anything technology-related. A handful of high-profile electric vehicle company IPO, including Rivian Automotive and Lucid Group, helped add to all the excitement. But all of the aforementioned problems with the EV market have culminated in one massive storm cloud that's rained all over the EV parade. It's been bad, really bad for EV investors. Tesla's share price is down 44% over the past 12 months, Rivian's has plummeted 73%, and Lucid's has dropped 72%. But here's the thing about storms that's hard to remember when you're in the middle of one. They pass. The rain stops, the clouds part, and the sun comes back out again. Just like with a long list of reasons to be skeptical of EV stocks, there are some very legitimate reasons to be optimistic about this market too. First, 60% of all light vehicles sold worldwide in 2030 are predicted to be EVs, up from 13% right now. The EV industry will be worth an estimated $1.4 trillion by 2027. Nearly 60% of Americans said they would consider buying an electric vehicle, up 7% from 2021, according to TrueCar. In addition to all of this, many governments are now incentivizing consumers to buy electric vehicles to help fight climate change. For example, the Inflation Reduction Act passed by Congress earlier this year included significant incentives for EV purchases, up to $7,500 toward a new EV purchase and up to $4,000 for used EVs. Legacy automakers see the writing on the wall and are investing billions of dollars to transition to EVs over the coming years. The disruption of the automotive industry is causing fears that some automakers will be left behind, but investors should focus on the new opportunities that disruption often creates. So I'm going to give you 2 good EV stock opportunities. If you're willing to take some risk, I think there are at least 2 EV stocks worth considering right now: Tesla and Rivian. Tesla is a leader in the EV space. It got a jump on the market ahead of traditional automakers and is currently the largest electric vehicle producer in the world. There are risks with the company, of course, one of which is CEO Elon Musk's new focus on Twitter. Additionally, Tesla's stock isn't cheap by any stretch of the imagination. The shares are trading at 60 times the company's forward earnings. But I point out that this is much cheaper than the company's price-to-earnings ratio of about 304 just 1 year ago. Tesla's EV success is undeniable. In the most recent quarter, the company delivered 343,830 vehicles, up 42% from the year-ago quarter, and it's on track to reach a vehicle production run rate of 2 million this year. The company's growing list of gigafactories across the globe is helping vehicle production accelerate, and Musk estimates that his company will reach an annual vehicle production of 20 million by 2030. Profits are also moving in the right direction, with earnings jumping 69% in the most recent quarter to $1.05 billion. And Tesla's net profit margin of about 15% is a feat of accomplishment for an automaker. Investors looking for an attractive pure play in the EV space likely won't find a more successful company right now. If your risk tolerance is even higher, Rivian might be worth considering. This is another EV pure play focusing on electric pickup trucks and SUV. One thing that sets Rivian apart from its EV startup rivals is that it already has a significant vehicle order from a large company. Amazon has already nailed Rivian down for an order of 100,000 electric delivery vans. Rivian is also picking up important partnerships, most recently with Mercedes to share a factory in Europe to split the cost of producing electric vans. While Rivian's vehicle production has faced some speed bumps, it continues to accelerate. Production was up 67% in the third quarter, and management reiterated its guidance of delivering 25,000 vehicles for full year 2022. Additionally, Rivian has plenty of cash on hand to continue building out the company. It ended the third quarter with $13.8 billion in cash, cash equivalents, and restricted cash, enough to keep things running until 2025, according to management. Rivian's stock isn't exactly cheap, with the forward price-to-sales ratio sitting at 58 right now. But Rivian is also making significant moves in the EV market that could pay off down the road. If you have a higher risk tolerance, opening a small position today could allow you to tap into Rivian's massive potential. An even better move would be looking into Tesla and why its stock price will bring back 100 times the investment for anyone who gets in right now. We explain exactly how in this video here.
And with that, we've come to the end of the video. I'd like to give a huge shout out to anyone who's made it this far. I hope you enjoyed the video. I'd also like to make it clear that this is a news and entertainment video, not investment advice. You should always do your own research and speak to a financial advisor before making any investments. Thank you all so much for your support. Don't forget to like and subscribe for the chance to win up to $20,000 in Amazon gift cards, and we'll see you in the next video. If you want more crazy trade news, how about this video we did?